Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the basics of the accounting cycle. From journal entries to trial balances to adjusting entries to closing entries, the post-closing trial balance, where the financial statements fit in, all of that key stuff that we use as the building blocks for everything else we do in accounting. Then in the last couple segments, we switched gears a little bit. We've talked about another set of basic tools, not part of the accounting cycle, but an important set of tools nonetheless, and that's our ability to convert from Gaap accrual information to cash flows, or from cash flows to Gaap accrual information. Again, not part of that accounting cycle, but a crucial building block or crucial tool that all of us need to be comfortable with in accounting. So specifically in the last example, or in the last session, we went through a specific example that let us walk through the conversion from accruals to cash flows, which for most of us will be the most common adjustment, since any set of Gaap financial statements is required to include a statement of cash flows that uses that particular transition. Now we're going to do an example of converting cash back to accruals, which we don't see very often except for small businesses that are just getting started in an accrual system and have to go from their checkbook to Gaap. So at the very end of our last discussion, I asked you to do this example on your own. Hopefully you did. If not, pause it here, take a few minutes and do it. The number we're looking for is $26,800. Now, if you tried the example and you got that number, you're probably good to go. If you didn't, or if you didn't try it, then you probably want to walk through the rest of this example with me. But if you're feeling comfortable and you got the right number, then maybe you can skip the rest of this segment. If you're already feeling comfortable with the concept, you might as well move on to the next lecture. For those of you sticking around to see the rest of this, let's go ahead and walk through the process of coming up with this 26,800 number. The good news is that whether we're converting cash to accruals or accruals to cash, the basic steps stay the same. So let's start with our step one, and that's to go through the balance sheet accounts and look for how the changes in the balance sheet numbers affect cash. So let's start here with accounts receivable. That's definitely a day-to-day operation. That's the kind of cash flow we're looking for right now. So let's see. Accounts receivable went from $45,000 to $35,000. Accounts receivable goes down, so cash goes up. If you remember, with all of our assets, it's a teeter-totter. As the asset goes up, cash goes down. As the asset goes down, cash goes up. So in this case, accounts receivable goes down, chances are somebody paid us, and we see that cash flow goes up. Next, we've got our inventory. Inventory increased quite a bit. It went from $38,500 to $55,000. So if inventory went up, chances are we bought it or paid for it. So I'm out $16,500 in cash. Hopefully I've made some of it back in sales, but that cash did go out. Next is my prepaid advertising. And in this case, the prepaid advertising went down, meaning I used a bunch of advertising this year that I paid for last year. So I have more cash in my bank account now because I made the payments last year. So let's see, that's a $700 change, and it's positive. Equipment, we're not going to worry about equipment because it's not a day-to-day operation to buy equipment. And we're not going to worry about land either because that's not a day-to-day operation. We will worry about it or use it when we do a full statement of cash flow. But for now, we're not going to. The other thing we want to look at is our depreciation. Now, if you remember, when we went through our accrual to cash conversion, we didn't do anything with this depreciation value. And the reason is depreciation isn't a cash flow. We just want to get it out of there. So we looked at depreciation expense and said, hey, that's not cash. If I'm going from accrual to cash flow, I'm going to cancel that out completely. In this case, though, I'm trying to go from cash to accruals. And even though depreciation isn't part of cash flow, a depreciation expense is part of accrual accounting, which means I need to find a depreciation expense. For now, we're going to use kind of a shortcut, and that is to just take the difference between old accumulated depreciation and new accumulated depreciation. In this case, from $33,000 to $50,000, so that's a $17,000 change, and that's the adjustment that we're going to use for now. In reality, there's more to it. This is a shortcut. In reality, you have to go back through the books and see if you got rid of any accumulated depreciation because of a sale or an exchange or anything like that. We don't have that information, so this shortcut works for us at this point. But just be aware, there's more to this. We just can't have all the fun right now. Okay, so for now, again, shortcut, just look at that change in accumulated depreciation and use it if and only if you're converting from cash to accruals. If you're doing accruals to cash, you're just going to cancel out depreciation expense and not worry about accumulated depreciation. That takes care of our assets then. Let's go ahead and look at our liabilities. Accounts payable, that's our day-to-day operation. That goes up. If accounts payable goes up, then we haven't made any payments, so we have more cash. Our next one, unearned revenue, goes down. Now, unearned revenue, if you remember, is when people prepay for work that we're going to do for them. So they've given us a check, we haven't done the work yet. So if you look at this, what this means is last year, in year 2, clients paid Bulldog Company $10,000 for work that they hadn't done yet. So they paid them the money so that they would get in the queue or make sure that Bulldog would do it exactly the way they wanted them to. In this year, we've only got $9,000 now of orders, which means we have less cash on hand. And you can think about it in two ways. We have less cash because people paid us last year, or people have prepaid us less this year than they did in the past. Either way, I have less cash in the bank. So I'm going to show that as a negative to my cash amount. And that makes sense too with our shortcut. If you remember, with liabilities and equity, we do the wave. So as one account goes up, so does cash. As the other accounts go down, again, so does cash. So in this case, the account went down, so cash goes down. Income taxes payable, that also affects our day-to-day operations. So that goes down, so cash goes down, and we'll show a $6,000 adjustment. Notes payable, that's not normal operations. We come down here to common stock, that's not normal operations. And down at the bottom, you can barely see it, retained earnings. Let me do this. There we go. Retained earnings also changes, but we're not going to worry about that either, at least not for our cash flow from operations that we're looking at right now. So that's step 1. Step number 2 is to build our worksheet. And I'm going to go down to the bottom and build that. So let's see. Even though I'm changing from cash to accruals this time, I'm still going to put accruals on the left. I'm going to do my change in cash here in the middle. That's all of these values that we calculated just a second ago. And then we'll have our cash flows over here. And this time the equation will be cash flows minus the change gets us to our accrual numbers. So let's go ahead and fill this out. Our next step is to put in the numbers we know. And in this case, we know the cash flow numbers because if you look at our income statement, this is a cash style income statement. It tells us that up here. But also all of our line items, cash received, cash paid, paid. So I obviously have my cash information. So I'm going to take all of this and we're going to put it down in our worksheet. And I'm not going to scroll back and forth because the computer doesn't seem to like it very much. I'm going to put the number first so it's easier to do the math. 125,000 positive was cash received from sales, or you'll often see that as cash received from customers. You have 12,000 cash received from rent. Then we switch to our outflows. And again, remember that with our worksheet, we have to make sure we have the positives and negatives in these columns. So cash received is a positive, cash paid is a negative. In this case, we paid $40,000 cash paid for inventory. Then we had $30,000 cash paid for salaries. Let's see, $2,500, again an outflow, cash paid for office expenses. $16,000 cash paid for income taxes. $1,900 cash paid for supplies. And finally, $3,600 cash paid for advertising. And just like last time, I always take a second and I make sure that these add up. I don't want any mistakes because I've just missed a line item. So let's go through these quickly. 125, 12, 40, 30, 2500, 16, 36. Looks like a positive 43,000. And sure enough, that 43,000 matches up with this number right here. So I am good to go. My next thing is to bring down these adjustments that we calculated. So let's start at the top. Accounts payable went up, or excuse me, the change in accounts payable, positive change, $10,000. So I need to put that in. Which of those line items will that match up with? Probably cash received from customers, since accounts receivable keeps track of what my customers owe me, what I'm due to receive. So I'm going to put that $10,000 down here. Change in accounts receivable, $10,000. Now we'll check that one off. Inventory, $16,500. That matches up with cost of goods sold down below. So change in inventory. We'll check that off. See, prepaid advertising matches up with cash paid for advertising, so $700. Change in prepaid advertising, $700. And now I've got this depreciation expense, and I actually didn't leave room for this, and I feel kind of bad. But down here at the bottom, I need to put this in. Change in accumulated depreciation, $17,000. Because I'm going to need that to get over here to a net income number. We'll check that off too. We've got three more, it looks like. Accounts payable. Accounts payable matches up with the cash paid for inventory, since we said in our discussions we're going to use accounts payable just to keep track of the purchase of inventory. We're going to keep all the other payables separate. Not an assumption you can make with a real 10K, but it'll work for us. We'll check that off. Unearned revenue, $1,000. Think about that for a second. Where will that match up? Probably cash received from customers, since this is money that they paid me in advance. So I'm going to put that down here. Change in unearned revenue, negative 1,000. And our last one is taxes. We'll go ahead and check that off. $6,000 matches up with cash paid for taxes. So change in income tax payable, and that was a negative 6,000. So now we have our adjustments, our changing cash numbers into our worksheet. That's step 4. Now, step 5, we're going to work across. And again, if there's multiple adjustments for any one line item, I'm going to add them up first so that I don't mess anything up with my equations. For example, right here, change in accounts receivable and change in unearned revenue both affect cash received from customers, so I'm going to net those out. So I have a $9,000 positive change. Now, this is where you might want to use your calculator, because sometimes the positives and negatives get kind of tricky here. Excuse me, not tricky, exciting. Let's say it that way. They get kind of exciting. All right? Remember, all the stuff that's challenging is just job security for accountants. So it's actually a good thing. If anybody could do it, we wouldn't get paid as much as we do. So we're going to start with $125,000 cash. I'm going to subtract $9,000 and get to 116 over here. And the accrual title for that is sales revenue. Let's see, rent, cash received from rent, $12,000. There were no adjustments, so that stays $12,000. This is rent revenue. Inventory, 2 adjustments. I'm going to net them out. So that's going to give me a negative 4,500 when I net them out. Now, here's where our signs get kind of fun. We're going to take a negative 40,000 minus a negative 4,500. So it becomes, let me just write this out over here. I've got negative 40 minus a negative 4,500, which means my net amount, what shows up over here as cost of goods sold, is going to be $35,500 because of how those positives and negatives work. That makes sense? Next then, let's see, cash paid for salaries and cash paid for office expenses, they don't change. So let's see here, 30,000 salaries expense and 2,500 office expenses. Taxes did change. Let's see, negative 16 minus a negative 6 is 10,000 negative. Income tax expense. Let's just translate this just quickly so that we know what this is. Remember that there's a story to all of these. We can say them in English, not just in accounting. So in accounting, we've made this adjustment and said, well, you take negative 16 minus 6 and you get a negative 10. The translation here is I paid out $16,000 this year. $6,000 in bills I owed from previous years, which means I added $10,000 of an expense in this period. Does that make sense too? I hope so. But that's what it means in English. $10,000 that I owed for this year, $6,000 that I've owed for previous years, so I ended up sending $16,000 into the government. Let's see, cash paid for supplies, no adjustment there, 1,900. Supplies expense. Advertising, negative 3,600 minus 700. In this case, negative 36 minus 7 gives me 4,300 here. Advertising expense, and I'm trying to save room for this depreciation. It's 0 over here minus 17, so depreciation expense negative 17,000, and that's what we should see. Depreciation expense should always be negative. So you'll notice I didn't worry about teeter-totter or the wave or anything when I was deciding on this adjustment. I just make it a positive because I know 0 minus that positive number is going to give me my negative expense when I do this conversion. Let's add these up and get our net income. So we've got our 116 plus the 12 and then minus 35,500. Let me fix that. This should be 35,500. Kind of hard to read my original number. So 35,500, 30,000, 2,500, 10, 1,900, 4,300, and then a negative 17. And if you add all that up, you get a net income of 26,800, which was the number that we gave you originally. That's our example, and that's our final number, at least for now. Again, when we do a full statement of cash flows, there'll be a lot more that we add to this. But for now, that's how we do it. So we're going to go ahead and close at this point, this little segment and this discussion. We'll come back next time and talk about using the worksheet for shorter problems, not just great big conversions like we've been doing. All right? See you in a few minutes.